Well, guys, we've finally done it. We've reached the danger zone and an area that we've been discussing now for the last few weeks. But what happens here will have profound impacts for all of us as traders and investors. In today's video, we take a look at the Microsoft and Meta results getting us to this point, the huge reversal off the bad GDP number, why this chart might matter more than anything else right now, and of course, the gaps that may need to be filled in the future. Could we be heading for the 1998 narrative still, and that means a double dip? Join us as we cover stocks, commodities, and cryptos in detail. This one is not to be missed. See you in just a moment. Well, welcome back everybody to the Daily Show. My name's Tom, and in today's video, we're discussing the latest macro data and key levels that you need to be watching. What a 24 hours that was. It was down, and then it absolutely boosted as we saw Meta and Microsoft come out with the goods in this earnings season. But was it good enough? Well, let's firstly begin by talking about the GDP. And if it's your first time here, remember to subscribe and smash that like button if you love markets like we do. So let's talk GDP for a moment. Negative on the quarter, down 0.3%, and mostly down because of imports. Imports surged, get this, 41.3% ahead of tariffs and took a massive hit on the GDP themselves. Exports rose 1.8% ahead of these tariffs, and obviously the trade deficit wiped over 5 points off the GDP. Now, this was the big story of the last 24 hours, and we saw basically two big numbers come out. Firstly, the ADP jobs numbers ahead of non-farms. So this is telling us that this Friday is going to matter. That is the jobs number, and that already had the market shrinking and selling off. And then even the GDP number, which is pretty much always known by the algorithms. Let's be real. The boffins at Wall Street know how to figure this number out pretty easily. Even that caused further selling throughout the session, down over 2% plus over the market. But everything ended up recovering, and that was thanks to the big earnings results. But really, what does this mean for the future? Well, it means that every one of these major economic numbers coming out for the US right now does matter. And why is that? Well, just take a look at this shocking chart here. When you take a look at container bookings from China to the US, they are falling sharply, over 40% down. And of course, that initial honeymoon phase of everybody buying everything ahead of tariffs is now going to turn into, nothing coming in for a while. And we're already seeing reports coming out that people cannot get certain products. I think the more worrying sign, though, really has to do with the change in the corporate capex plans. And this basically means that there is not spending, or that there won't be that much spending on the future growth of the US economy from at least businesses. And you can see this steady and massive decline here that usually needs to be counteracted, e.g. over here, by the Federal Reserve in the form of cuts or some form of government stimulus in the form of potentially tax cuts. So if we don't get those types of things, what could this mean for the US economy? What could this mean for the SP500? Well, of course, it could mean that we're heading into a recession. And that's what everybody has been discussing, I'm sure, in your feeds, in your social platforms, and even in your families right now. Everybody is absolutely terrified. And this is leading again into every one of these major decisions or major bits of data causing huge volatility. Now, funnily enough, this is all happening at that key level that we've been discussing, 5,600 to 5,660. Now, we've talked about this level several times over the last couple of weeks, and it's always been our major level where we believe dark pool liquidity, that is Wall Street liquidity, could activate shorts. And it will be a deciding factor on whether this market is really going to see a significant recovery with that Zweig breadth thrust, or it's going to struggle. According to Mike Wilson, he believes the ISM manufacturing data coming on Thursday open morning, that is going to be incredibly important. And of course, as we mentioned, with all of this news coming out about the GDP and a potential recession, we're now seeing 4 rate cuts being priced in for this year, according to the latest FedWatch tool. So that basically means that while the Federal Reserve has not been accommodative yet to the markets, it is expected that that will have to happen. Now let's take a look at what this all means for us as traders and investors. First up, we've just seen 7 days in a row up. Now, it didn't look like that at one point in the session with it being down so much, but by the end, it was up. And with the earnings coming out, of course, we have two more major earnings here, Apple and Amazon this week. Could it be that we actually run out of good news after that point? Well, while we're under the 200-day moving average, which as you guys know is an incredibly important read, it turns out that when we see reads like this, we see these super big strength runs. Maybe one day later we're more bullish, but when you have a look at something like 4 days later, yeah, the result is pretty shocking. And this is not just a couple of reads. This is quite a good data statistic here from Subaru Trade. And you'll notice some of them end up selling fairly hard. 4 days later, only 23% of the time is the market actually up after a read like this. Now, to make matters even more scary in some ways, what happens when we have a very specific statistic? The S&P was over 10% down during a month, then it ends only 2% down below the close of the last 2 months. Now, last month itself. Now, why is this important? Well, it shows the volatility of a market, the speed of which it runs. Now, many people are now calling for a DCB, a dead cat bounce. That is a false rally narrative that makes it seem like everything's all good, but that ends up being the beginning of something much bigger. And of course, the last time we saw this was the 1930s. And of course, that was after the Roaring 20s, which a lot of people are speculating on right now. The last time we actually saw tariffs in the biggest levels like we are right at this point. And we also had Zweig breadth thrust back then that were failing. Remember, a great read, such as we'll see later, the Zweig breadth thrust, which is pretty much one of the rarest and best reads, they only really failed around that particular period of time. Let's look at the good factors here, though, and that was, clearly the Microsoft earnings. App Economy Insights, cool chart here. Always enjoyed this one. Let's read out some of the big numbers here for Microsoft. Azure up 35% year on year. 16% of the Azure revenue attributed to AI. Revenue was up 13% year on year, which is massive. $70.1 billion, which is a $1.6 billion beat. And this is why we knew earnings were going to be good. It's just the forward guidance that's going to be the problem. And EPS was a $3.46, which is a 24-cent beat. So pretty spectacular stuff. And one of the things I liked most about this, well, in some ways, as an investor anyway, was that Microsoft's CEO actually came out and said that between 20 and 30% of code inside the company's repositories was written by software, meaning AI. Now, you might say, why do I like that? What that actually means is it means that the finalized version of how do you make an already massive business end up making more profit, frankly, is usually in job cuts. Now, why is that important? Well, of course, we do know that labor is usually one of the biggest inputs. And as the stock market, not so much in terms of people keeping their jobs, but as the stock market, generally people will see that as kind of like growth in a late stage cycle business. So because Microsoft is now getting so saturated, especially in its key markets, that is going to be one of the big growth kind of stories, I think, of the future, which is just going to be basically becoming more lean and mean. Now, when it comes to estimated number of human workers expected to be replaced by humanoid robots, take a look at this chart. Wow, it's terrifying in some ways. Have a look at how things go from where we are right now, or not even here yet, to where we'll be by 2050. Wow. If you're not on the AI investing bandwagon, then it might be a big problem later on. And while it does seem overpriced for now, this is something that I would keep in the back of my mind for the future. It's most likely going to happen. Now, when we take a look at Meta Q1 financial income statements, they were pretty good as well. You can see here that things were on fire. Particularly, we saw here the daily active people up 6.6 or 6% year on year to 3.43 billion. We saw ad impressions up 5%. We saw operating margin up. And I think this is just, again, a story of the time. Similar to Google, what's happening is people are going and getting their alternative news. Like you're watching today's video, you're getting insights into the markets we're all talking about together. We obviously look for dark pool liquidity, options flow, all of this stuff, and you just can't get it in other locations. So obviously we're using social media to share and to also absorb some of this content. Now, we did mention before Zweig breadth thrust. While those earnings were awesome, Zweig breadth thrusts were pretty damn good for the last 50, 60 years, and obviously had some incredible stats surrounding them. When did they fail? Yeah, you guessed it, the 1930s in particular. Many quick market sells followed by huge market runs. And that's what has people concerned because of that narrative of tariffs. Are we heading into a similar situation? Be interested to know in the comments down below whether you think a recession is coming. Are we already in one, or do you think we're going to miss it? Now, CTA positioning is, of course, in the favor of the bulls. We've been talking about this for about a month now. We knew that April would have CTAs buying. Turns out they were. And even according to Goldman Sachs, post some of these big earnings, in all situations, they still have CTAs, that is commodity trade advisors, basically momentum funds. They're actually purchasing into the market. So that is a good sign. And it does help to usually navigate May in a more positive way. Now, if you're looking at purely statistics, you're going to see a lot of videos saying sell in May and run away and, disappear and run for the hills. But just remember, at least in the last decade, there's only been one of those periods of time. So statistically, May is not going to be that bad period. But could we be heading for this, which actually leads to, of course, May being bad, which is that we sell now that we've hit into this supply area, being the 5600 to 5660 zone, and we see a doubling dip that ends up as a rally with the Zweig breadth thrust. Well, of course, it really comes down to the news media. And why that is important is because we just saw what GDP, jobs numbers, which are the advanced ones that usually do nothing to the market, how that jolted the market, caused the VIX to spike up, and obviously caused a pretty decent sell-off throughout the session. So when we run out of the good news, let's say the Microsoft and Meta earnings, and maybe Apple and Amazon, maybe they're a little bit worse, I think, because of the nature of their businesses and how tariffs will affect them, then could we actually be seeing a sell at around this area? Well, that will be proven most likely by dark pools. And while we saw dark pools purchasing into this area, and of course, since then we've had one of the better rallies we've seen in a while, then we also may get them selling. So we'll be updating you guys. Make sure to subscribe if you're interested in that content, because we will be bringing that to you very, very soon. Gold to silver ratio, still looking pretty good. Silver, obviously, superiorly underpriced to gold. And while gold's been dropping, silver's been barely holding on to the current price. And we'll look at that later on today's video. We also know that when gold tends to stumble, which it is at the moment, and we already predicted, or, we already found the data for this about a week and a half ago. Don't really want to predict too often, but sometimes you're going to have edge. We usually do see that Bitcoin can sometimes start to play catch up. And so far, that has been true. And as you guys know, earnings coming, still big ones. Stick with us through earnings season. You can see here that Amazon and Apple are expected to be huge moves. And the options market's been relatively on. Microsoft 6-7%, Meta about 6-7% after hours as well, down a little bit from the expected 9%, but still some big stuff. And Qualcomm, not very good in the result. I think they were down 6% in after hours trade. So maybe Joe, check that out. But that does bring up the problem. Semiconductors, which is one of the most important sectors, kind of like a mixed bag at this stage, where we'll be very much awaiting something like NVIDIA earnings soon. Now let's have a look at the overall central bank liquidity indicator. No changes here over the last 24 hours, so no real supportive Fed. But you can see that we have started to make pretty big inroads into filling that final gap, which sits at 56.70. Now, anything in here we call the danger zone. And the other danger is that we've left quite a few gaps behind. We've got a gap here. We've obviously got a gap now from today. We're going to open up at the time of this recording over 56.10. And we have a gap that's been left from 51.53. And that strengthens the argument that the potential 1998 narrative could come through, and then we fill gaps and maybe rally up. It also strengthens the argument that people might have that it's bearish and that we're going to make a new low. Although I would say that 4,700 is a super, super critical zone, and that area is likely to have some form of Wall Street support based on everything we've been doing in terms of analysis. Now let's take a look at the US 500. It has hit the most traded zone. You can see that wild action where it took the low, and then by the end of the session, absolutely rallied up. I wouldn't blame people for trying to short around here, but maybe options was the best activity at that point, because obviously the market was looking pretty bad, rallied up. That's usually the way that you would look at the short. And then, yeah, Microsoft and Meta blowing out the numbers and just absolutely pumping that market in after hours trade. So where are we? We're at the most traded zone. We're at the key resistance we've been discussing for quite some time. We have no signs of weakness just yet, but that could all change very, very soon. I think for options traders, they're going to be looking, or you guys are going to be looking very closely at this next kind of 100 points, as this is the area that we were looking for. And now we're here. So will we find resistance? 56.10, that is now the call wall of the next 24 hours. You'll notice no surprises, 56.50, 56.60. Yeah, the major call wall for the 2nd of May. So, like clockwork, the technical analysis and the options levels end up spiking on top of each other. And you might say, who the hell is buying calls at these levels? I don't really know. It's probably retail. But at the same point, of course, there is always another side to it. And Wall Street may want to actually hold prices under these zones. Remember, this will enter into positive gamma should the market be able to take these levels. So if we get past 56.10, we could easily push to 56.60. We get past 56.60, could we be going towards 5800? That's the next question. You'll also notice a lot of puts starting to appear on the markets when you're looking at the OPEX of May. That is the major options expiration. And it seems like heaps of people are fighting over the 5800 level in particular. Let's now move over to the Tesla. We've got 300 for Tesla acting as too much resistance for now. Again, major call wall. If you took profit there, congrats to you. And basically NVIDIA, again, the semiconductors not faring that well over the last 24 hours. That 115, 116 most traded zone, just too much for the NVIDIA and the semiconductors at this stage. Watch that semiconductor versus SPY chart. It's going to be important. US 30Y ended up going up a little bit, even though you might think it should have gone down based on the GDP numbers. Complexities here, obviously continuously watch that. We've got overall bonds and yield spreads end up being a little bit uptick. So, I would call that neutral at this stage. And I think this chart is worth another look, which is the technology versus SPY. So that is the technology sector. Notice it's hitting resistance, hitting the weekly 20 moving average at the exact same time that we're seeing the SPY hitting the weekly 20 moving average kind of zone. And you will note that on the way up, the 20 moving average was an incredibly good one. And on the way down, it's already been a good one. We do know that this is a very well respected moving average. So it's just another kind of point here where we've got to be very, very careful. We call this the danger zone for a reason, because it's very difficult to pick a position until you see structural creation, dark pool flow, something like that happening in these markets. The US dollar is actually strengthening, and of course that's strengthening this idea of the inverse head and shoulders. That's putting pressure on things like gold, which continues to fall. Will it hit 32.20? Seems likely. And as we've suspected, we've been talking about this. We thought gold was getting too rally-like, and I've got to say it, we did well. Well done, guys, because, we were talking about this and most people said we were morons. And ultimately, you've got to remember the concept is that when everyone's piling in on something, even though we've been very bullish on gold, and I continue to remain bullish with the long-term horizon, it is about when things get overrun by too many people that they tend to go too fast, too hard, and they have to have these recoveries. Now, of course, this isn't the biggest recovery ever, and I still think it's possible to go down to the 3,050 kind of area or 3,000 zone, but it's just another great learning experience for us as traders and investors to see how things get overblown. And the story and the narrative is great, but just remember the story and the narrative have been great for 2 years, like we've been talking about. So it's not that they changed. The story and the narrative was also good. It's just that people became aware of that story and narrative. But there's a big difference between 1,800 gold and, of course, gold at $3,500 an ounce. Do ultimately I think it's going to go higher? Yeah, of course. But again, it's about, timing on these things. Now, silver has suffered and it's down to a very key support area. It really needs to find a rally at very, very soon if possible. And you can see here that it's holding its own versus gold. You can actually check that out by looking at silver versus gold ratio, where you can see here silver is stabilizing. And I like that a lot. But, silver, again, needs to hold this zone. Now, what hasn't held the zone is oil. It gave up everything. why I don't like it from a geopolitical standpoint. Very dangerous commodity. And this actually is a worrying sign, because if oil is tanking like this, then you've got to ask yourself, is growth absolutely in the hole? And when oil does this, that is a weakness in the overall world economy. And you can see here that copper also got absolutely smashed over the last 24 hours. So it's going to have a strong reaction off this point. It was down like 6.5% at one point in the day. So that's very weak there for the economy. Now, Tesla managed to hit 300-ish just before, sell off, no surprises, big supply area. I'd be interested to see how this ends up correlating, but keeps coiling like this, then breaks out. Next stop, 330 to 350 would be the next target. So there could still be a good bullish trade here for Tesla, regardless of our opinions. But the main thing is it's all about the price action. So we'll be watching the coiling here to see how that looks. Semiconductors versus SPY, you guys know the drill. We're looking for semis to outperform the S&P. At this stage, they are struggling with this trend zone. And that makes sense because we're seeing NVIDIA struggle with the 115 most traded area as well. HSI, that's coiling. That is really tight range. I expect a large move out of here. If it ends up gapping down, remember that would be an island reversal towards the negative side, which could show that the rest of the markets are all turning as well. Remember, this is the Chinese market. So at this stage, yes, it's in a rally. Yes, it could fill the gap, but that is a very tight range. So it'd be interesting to see how that plays. US 2K still not hitting 2,000. That's the resistance. Maybe it coincides with the S&P here. Pretty weak actually over the last 24 hours. And Nasdaq hitting the magical weekly 20, which is a huge point. Actually hitting above my resistance zone. So because of Microsoft and Meta earnings, this actually now has beaten my expectations on where I thought Wall Street might get involved. And particularly, we're going to be looking for dark pool liquidity over the next 24 hours. Could it rally more? Of course it could. But I think it's best to just have patience here and to see how the market ends up reacting to this zone. Well done, I guess, if you've been bullish into that. Now, Bitcoin still melting up, still slow, still melty, still the kind of thing that you don't really want to short against. And it is basically a series of higher highs and higher lows on small timeframes. Now, we haven't seen a higher high since, what was this, Friday 25th. So we do need to see Bitcoin kind of move up, but you can see the consolidation. This is resetting indicators, and it's all happening near the peak. Now let's move over to the numbers coming out. We've got ISM manufacturing PMI at 10 o'clock New York time on Thursday. That's expected to potentially move markets. And then, of course, the big one here, the jobs numbers, non-farm payrolls, 1 hour before the market opens. That's going to be a volatile event. Two massive volatile events, Amazon and Apple. It doesn't get much bigger than this. And that's why we're seeing a critical zone being reached. Remember, markets tend to move towards equilibrium or a key level before these big news events. That's exactly where we find ourselves. Sure to be fireworks around these zones. If you enjoyed today's video, then remember to subscribe, smash that like button, guys. Follow us over on X as well. If you're interested in finding out more about how to replicate trades, check out our courses over on our website, fxevolution.com. And thank you so much for watching. As we always like to do in terms of summary here, the GDP numbers, obviously, while shocking, will not be enough to convince me of a recession by itself. The ultimate truth here is always in the structure of markets. And this is probably the most pivotal point. Is this a fake swag breadth thrust? Are we hitting the 1998 narrative? And of course, we have to expect the unexpected when it comes to dark pool liquidity. I'll be looking for the signs, as I'm sure we all will be, and we'll share them here together. Thanks so much, everybody. Bye for now.